counterparty risk. I think it's something that's fresh in everybody's mind with the collapse of FTX. FTX was either the second or third largest exchange by pure trading volume internationally. And for that to collapse, a lot of people got rug pulled in that. And so people are naturally wondering, where can I, trade and leave capital that, has relatively low counterparty risk. We'll dive into that, but first I just want to talk about the unique aspects of Bitcoin as an asset. Bitcoin, is very unique in the sense that it doesn't have any counterparty risk if it's held in self-custody. And that's a way that's unique for Bitcoin compared to any other asset, really. And people will say, well, gold doesn't have any counterparty risk. And that's true if you're talking about, holding a small amount of physical gold in your possession, then it's very similar to self-custody Bitcoin. But once you start talking about large sums of gold, then you need to hire security to guard it, especially to transport it. And that security, adds a layer of counterparty risk, right? Because you're relying on the security agency to perform their function and to secure the gold. Bitcoin is unique in the sense that it's a bearer asset that, is very similar to gold, but has even less counterparty risk in the sense that, you can have your 12-word seed phrase in your head, and that's totally unconfiscatable and uncensorable, and in a way that it does really have zero counterparty risk. Now, there is the risk that, you might lose your own keys or lose your seed phrase. That's obviously a risk, but that's user error and not counterparty risk. So I think I just want to start from the basis that self-custody of Bitcoin, is the best way to eliminate counterparty risk. But as a trader, if you want to trade and have capital on an exchange, as you would as a trader, you do have to embrace counterparty risk. Inherently, right? You can't trade without embracing counterparty risk. So the question is then, what are the best places to embrace counterparty risk and how to minimize that? Well, I would say, maybe if you are bullish on Bitcoin, a good starting point would be to not have the majority of your capital on different exchanges. And if you do have them on different exchanges, maybe spread the portion of your capital that you're trading between two trusted custodians. And it's just a way, to spread, your counterparty risk out, right? Rather than concentrating it in one custodian. Maybe that means self-custodying the majority of your capital and then spreading the lesser half between a few trusted custodians is a good way. That way, if you do get hit, you're not going to be taken out of the game completely. Now, it's unfortunate that, you can't trade crypto on a brokerage like Fidelity and TD Ameritrade because, for obvious reasons, those would have even less counterparty risk. Now, of course, they would have counterparty risk, right? I mean, any brokerage you're trading on, even something like Fidelity, theoretically could go out of business and, then you become an unsecured creditor. If you're trading stocks on Fidelity, if Fidelity were to go out of business, then, your securities that you hold on the brokerage are not FDIC insured. Now, obviously, a brokerage like Fidelity has much less counterparty risk than an offshore exchange, for example, in crypto. And I believe Fidelity is actually offering crypto services relatively soon. Not available yet, but it should be available, I think, sometime next year for retail traders. So that's something to keep an eye on. Now, where is the areas, right now that you can trade and have capital on that have roughly lesser counterparty risk? Well, I think it's important to start by analyzing the major red flags that you want to avoid when it comes to an exchange. So the major one, right, is if an exchange has no jurisdictional home and they're dodging regulators, right? Maybe they're a fly-by-night organization. A good example is Bybit. Has no even legal address. This is one of the things that it was a red flag with FTX, right? FTX had FTX US, the exchange, but that exchange was very, very small compared to the international operation from just a volume perspective. We're talking, 1/30th of the size. So it gave the illusion that they were under regulation, but really the overwhelming majority of the business was international, based in the Bahamas, and not being regulated, right? Not no one was really looking at their books. And any of these exchanges where if they're domiciled in, say the Bahamas, for example, like FTX, the Bahamas isn't really regulating them, right? They're a little bit more so just happy that somebody like FTX is there so that they can kick them a little bit of revenue, right? It's not like being under the scrutiny of U.S. regulators. So that's a big thing there, right? I think a lot of the exchanges that, are going to be more reputable are the exchanges that are audited on a regular basis by U.S. regulators. So in my mind, there's really three exchanges that fit that bill, and that would be Coinbase, Kraken, and Gemini. Those three exchanges are all, audited and regulated by, U.S. regulators to make sure that they're holding customer reserves one-to-one, right? They're not rehypothecating customer reserves. Now, there's a little bit of nuances between those three, and Coinbase is definitely the king as far as simply size of the exchange and volume traded relative to Kraken and Gemini. But that doesn't necessarily mean that it's the best, right? The credentials that they have come from other sources as well. Now, one of the other things to keep an eye on when you're trying to find an exchange not to keep capital on. One other thing that we knew or we found out in the wake of the FTX collapse, that really the heart of the whole Ponzi scheme that was being created and propped up on FTX was the FTT token, right? The FTT token was being sold to Alameda Research at steeply discounted market prices, which was then used as collateral for loans issued between Alameda and FTX, which really took the form of customer deposits. And Alameda posted collateral for those loans in the form of customer deposits in FTT, which is essentially created token, which has a market value and is represented on the company's balance sheet as an asset, but it's really just a form of accounting fraud because that asset, in a crisis situation, that asset is going to deplete to zero very, very quickly, and that hole in the balance sheet, right? It's a way to paper over a hole in the balance sheet, right? So I'd be highly skeptical of any exchange that issues a central token. And that really applies to a lot of exchanges. I mean, a lot of exchanges do that and, are caught up in that type of scheme, all the way up to an exchange as big as Binance, right? They issue Binance Coin. So, it's hard to know exactly what those exchanges are doing with those central tokens. But it's very hard for them to resist the temptation to essentially print their own money, right? If they create a central token, create artificial demand for it by, using it to subsidize trading fees, then you can effectively print money in a sense. But to represent that money as an asset that will hold up under crisis is highly misleading. So just a warning on that. It's not to say that, I'm not making the claim that Binance is insolvent and they're rehypothecating customer funds and using those customer funds in the form of loans backed by BNB, in the way that FTX did. Obviously, I can't confirm that. That would be total speculation. But the reality is, they're not a public company. They're not under regulatory oversight. There's really no way to know what they are doing, right? So, I'm not making the claim that Binance is insolvent, but they do kind of fall under the category of companies that I would generally be distrustful of, right? And there's a lot of red flags there. So, if you are trying to deal with counterparty risk, you probably want to avoid exchanges that, are overseas. Maybe they're based in the Caribbean, based in some tax haven country. It's a major red flag right there. Again, kind of tying back into what we were saying earlier, if you have a large spot position in Bitcoin, you want to hold a significant amount of that position in self-custody format, right? Or on the flip side, right? If you're bearish and you don't have a large exposure to Bitcoin, if you have all of that capital in the form of stable coins on an exchange, well, you're embracing a lot of counterparty risk as well, right? So it's just something to keep in mind. Now, I do think, if we dive into some of the regulated exchanges, they're US-based. We mentioned Coinbase, Gemini, Kraken. These exchanges are all under US regulatory oversight, meaning that their reserves are backed one-to-one and verified by accountants and auditors. But there are a little bit of differences there. I mean, Kraken, Gemini, Coinbase, they've all been around for a while. That's another good sign. They've been around for multiple cycles. And, Gemini, for example, they are regulated by the New York Department of Financial Services, which is one of the strictest regulatory bodies in the entire country. So that lends towards, trusting them relatively as a custodian. Now, they may have gotten into trouble with their Gemini Earn program and their connection with Genesis. So, that's a little bit of a red flag there. Now, one of the things that separates Coinbase from the other exchanges is the fact that, every other exchange is a private company. Coinbase is the only public company, and they're also, that means that their financials are public, right? You see people on Twitter making statements about Coinbase's financial structure and their balance sheet that are, sometimes they're accurate, but a lot of times people will post things on Twitter that are completely inaccurate. And I don't think those people realize that, Coinbase is a public company. Anybody can go download their balance sheet and look at it for themselves and make their own decisions. And I think that, that type of transparency is, elevates Coinbase to another level as far as transparency and security and what you would want to see right now. Hopefully other exchanges go public as well. The other thing that is worth mentioning about public companies is public companies are just the structure of a public company is better suited to raise capital if they need a capital injection or they need some type of liquidity. It's going to be a lot easier for somebody like Coinbase to do that than some private exchange. Hopefully more exchanges go public in the future. I think another thing, Coinbase has going for it is that BlackRock chose them as a custodian. Now, BlackRock, who knows what their level of due diligence is. They were an investor in FTX, but they were an equity investor in FTX. So that may discredit this entire argument, but I do think that, the fact that BlackRock chose Coinbase custody as the custodian to handle the custody of their private spot Bitcoin offering for their clients, that does say a lot for Coinbase as a custodian. Now, this isn't an advertisement for Coinbase, and I really don't want to fall into the territory of, shilling Coinbase or advocating for them, but, if we're looking at a certain set of factors to try to determine risk, I think Coinbase would fall into the category of companies that provides the least counterparty risk. Now, I could be wrong with that. Who knows? But I'm just trying to flesh out the logic that I'm using to do that. If I had a significant amount of capital that I wanted to trade in an era of counterparty risk, I would feel most comfortable posting that capital to Coinbase and trading on that platform. That it's not financial advice, certainly not a recommendation for anybody, but just trying to share my thoughts and my thought process on the concept of counterparty risk. Now, maybe you are entirely spooked and you don't even want to have any capital on the exchange at all. That's totally understandable. Of course, if you're bearish, you can just hold fiat in a bank account. Or if you're bullish, you can just hold your Bitcoin in self-custody. I mean, that really is the the way to totally mitigate counterparty risk. And this is a concept that is uniquely frustrating for traders, right? Because in order to trade, you need to not only have some type of shield against counterparty risk, but have some type of insurance or some type of comfort that you won't get rug pulled. And the reason why I mention that is because, if you are afraid of being rug pulled and losing your entire capital base, then that fear is going to seep into your trading and is going to affect your decision making, and it's going to cause you to make trading errors that you wouldn't make, if you were trading on some type of exchange that offered FDIC insurance. It's not really available for really any brokerage that I'm aware of, but maybe it's available, for example, if you're trading Forex or other markets. I don't know, but it is something to look into, especially if you are a beginning trader, or you're particularly affected by what's been happening with FTX, and you just want to cover all the bases and be more safe than sorry. Bitcoin is a very difficult asset to trade, just because it operates on an exponential curve. One way that demonstrates itself is a lot of times when Bitcoin will take off and really mount a face-ripping rally, it'll sort of just go, right? You'll have a downtrend, and then you'll have a supply shock and a short squeeze that just turns into a rally where Bitcoin just starts running, right? Because of the supply constraint nature of it and the exponential curve on the supply-demand distribution. And that makes it very difficult for people to trade who are used to trading not logarithmic assets, but assets that don't operate logarithmically. And following up on how that affects Bitcoin's price movement, a lot of times when you see that short squeeze and that supply shock, Bitcoin will just go parabolic, right? And people will be waiting for a higher low to form to give them a little bit more comfort after that downtrend is broken. And meanwhile, while they're waiting for that higher low to form, Bitcoin is just ripping for new highs, right? Because the supply squeeze is playing out. So a lot of people, have noticed that they actually have greater success trading Forex than they do trading Bitcoin. Now, as Bitcoin, gets more adoption and has a larger market cap, it will, tend to trade more like the Forex markets do, and it may, tend to be easier to trade, so to speak. The reason why I mention that is, I tend to see the most liquid markets tend to play the most technically. So a good example of that is, you go to Euro USD. The Euro USD market in the Forex markets is the most liquid market in the world. And, because it's the most liquid market in the world, it trades extremely technically. And a lot of traders really like to trade that market because of that fact. Now, of course, you can go to the other extreme and go to shitcoin number 2000, right? It's going to be the exact opposite of the spectrum as far as liquidity goes. It's not going to have any liquidity. And because of the lack of liquidity, it's going to trade extremely untechnically, right? It's just going to pump and dump. So that's something to keep in mind. If you are beginning as a trader, why not make life easy? Again, none of this is financial advice. I just wanted to follow up on the topic of counterparty risk because I know it is fresh in people's mind, and it is extremely important, because a lot of the big risks are the risks that, we can't manage with a stop loss. Those are risks, right? Price-related risks. But if we are following a risk management program, those are never going to end our career, right? But a good example is, if you had all your capital in FTX, it doesn't matter how great your risk management is, right, with your stop loss placement and all that. If you got rug pulled, you lost all your capital. So in a way, the risks that represent career-ending risks are really the biggest risks because they can't be managed. Not that they can't be managed, but people tend to overlook them, right? Because they're existential risks. And I guess the moral of this video is that those are extremely important to pay attention to because, if you want to have a long trading career, you're going to run into those existential risks, right? Those risks that can't be managed with a stop loss. And to be able to survive them and endure them and at least contain them, so if you do get caught up in them and you do get hit by something like that, at least the risk is contained and you're able to survive and pick up the pieces and move forward. Anyway, I hope you guys like this video. If you do like this content, make sure to leave